A new report from RBC Capital Markets is suggesting that mortgage renewals pose a major risk to Canadian banks, with up to 60% of mortgages coming up for renewal in the next 3 years. And that report, along with the fear that variable rate mortgages with fixed payments are becoming an even bigger problem than expected, seems to have Tiff Macklem pumping the brakes, suggesting that interest rates could start to come down before we hit the 2% inflation target, which is a major sidestep from the previous statements that he has made. And it's becoming clear that along with the fact that Canadians are facing higher and higher payments on pretty much everything and higher costs on pretty much everything, there is substantial risk to Canadian banks when it comes to those mortgage renewals. The good news is there's some simple things you can do to insulate yourself from the potential problems in the future. But before we get into it, my name's Nolan Matthias, and if you are looking for the latest Canadian real estate news, this is the place. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. And if you're looking down right now and you're going, hey, I thought I was subscribed to Nolan already, but you're not seeing a subscribe button highlighted, well, that's because this is a brand new channel dedicated to Canadian real estate. The old channel still exists. You might be subscribed there, but you may not be subscribed here. So make sure you double check that you are, so you're getting the latest Canadian real estate news. Oh, and if you're into wealth building and more general and global financial conversations, make sure you check out the other channel as well. And if you haven't already heard, I'm retiring my Rate Secrets course right now. You can get it for $27. It includes all the future updates that are coming soon, as well as information with respect to renewing, which is going to be hugely important in the coming 3 years, especially considering that according to RBC Capital Markets, up to 60% of mortgages will be renewing in the next 3 years. And there's some really important information you need to know, like how to renegotiate your mortgage and how to shop at other places in order to get a better rate that will save you tens of thousands of dollars. So for $27, which is the retirement cost, and again, includes all the updates that are coming to that course, as well as a copy of my book, Mortgage Secrets, you pretty much can't lose. And while I can't guarantee that it's going to save you tens of thousands of dollars, I'm pretty confident that it will. Okay, so let's get into it. Let's discuss the RBC Capital Markets report around mortgage payment shock and the fact that mortgage renewals are one of the biggest risks to the Canadian banking system right now. And this is a serious issue because it could potentially lead to not necessarily bank failures, but big hits to the profitability of these companies, which could have rippling effects throughout the economy. We're already seeing banks, including RBC and Scotiabank, lay off massive amounts of people. So this is something that we need to be paying attention to, especially if you have a fixed rate mortgage or a variable rate mortgage with a fixed payment. And I'm going to give you some tips on what you need to do if you have either of those types of mortgage at the end of this video. Okay, so let's get into it. Let's take a look at what's going on with this report. So this comes from RBC Capital Markets, like I said, and the news is really interesting. Payment shocks from mortgages renewing at higher interest rates over the next 3 years may pose a substantial tail risk to Canadian banks. 60% of all outstanding mortgages with Canadian chartered banks will be up for renewal during the next 3-year period. That makes sense because we typically have 5-year mortgages. So in any given year, 20% of them will most likely be up for renewal. And their big concern is that this will lead to what we'd call payment shock. We've talked a lot about payment shock in the last couple of years on this channel. It's one of the reasons why we suggest variable rate mortgages with adjustable payments so that that shock is felt gradually as interest rates go up rather than all at once at renewal. And this is one of the primary reasons that people choose these types of mortgages, other than in general, they tend to save money, although the last couple of years have clearly not been a period of time where if you got those mortgages, you saved a ton. If you had them prior to all the increases in interest rates, yeah, you already had saved a bunch of money and you're probably still ahead. But if you got them right at the bottom, well, there's a good chance that you've been paying more and you're a little bit behind. Now, that doesn't mean that you won't make it up over the coming years if you stick to that strategy. But what it does mean is that you got caught in a weird economic situation that nobody expected. Regardless of what anybody says, nobody expected interest rates to go up as much as they did, including the Bank of Canada. So it's one of those times in life where the unexpected happens and you just have to figure out a way to deal with it. I'll show you a little bit of information about how people are coping with that a little bit later on. Now, this report is suggesting that there will be a 32% payment shock for those renewing in 2024. So in other words, the payments of people who have mortgages that are coming up for renewal next year are going to see their payments increase by up to 32%. Now in 2026, they're suggesting that the payment shock could be as high as 48%. Now there's one part of this article and part of this report that actually has me really concerned. And it is the fact that the experts wrote they are not concerned about mortgage losses because mortgage delinquency rates and unemployment are currently below pre-pandemic levels. Now, my concern here is that this is something that is going to change. I do believe that if interest rates stay high for much longer, we are going to see unemployment, and unemployment leads to delinquency, and delinquency leads to a whole bunch of other problems, which could be a big problem for the bank. So I don't think that this is a non-issue, but they're saying that at this point in time, they don't see it being an issue. Now, this could be partially them trying to calm the storm with respect to this report, or perhaps they genuinely believe that it's not an issue. But regardless, I think this is something that we need to watch. The unemployment story is something I've talked about quite a bit here, and it's something that we're going to continue to talk about because when interest rates go up, the lead indicator is unemployment with respect to what happens next in the economy. Now, obviously, Canadian banks have said that they're working to lower the impact of these shocks. If you have a variable rate mortgage with a fixed payment, they've probably reached out and tried to convince you to lock into a fixed rate mortgage, which might not be a bad idea, but they're trying to make sure that people are prepared. That being said, there's a very large number of people who are not prepared for what's coming, and they're just ignoring it. And I got to tell you right now, you do not want this to be you. But what's interesting is right on the heels of this report coming out, Macklem is now suggesting that the Bank of Canada could cut rates before inflation reaches target. And I'm not sure why he made this statement, but I feel like it is designed to make people feel a little bit better about the fact that their mortgages are coming up for renewal and they're going to have to be renewing at higher interest rates. Now, that being said, this isn't a promise that interest rates are going to come down anytime soon. What he is saying is that the increases to interest rates generally take some time to take effect. And as a result, they could see inflation starting to come down and have opportunities to lower interest rates as inflation comes down because they know that the previous increases have already done the work. And if the momentum is downward, they can start decreasing interest rates at the same time and try to catch inflation pretty much at 2%. Now, that's going to be a tough job. They've clearly had a tough job the last couple of years. It's not going to get any easier, but don't take this as a sign that you should be getting a 1 or a 2 or a 3-year mortgage, hoping that rates are going to come down exactly as you hoped. Because the Bank of Canada has made a lot of predictions over the last couple of years, they've put out a lot of forecasts. Those forecasts have been used to make buying decisions and mortgage decisions. And by the way, those forecasts were wrong and led a lot of people to make the wrong decisions. One thing I have to point out is anytime I've talked about variable versus fixed, it's never been about trying to time the market. It's been about a long-term strategy, and it's been about using the data that we know from the past in order to make decisions about the future and to choose the mortgages that are most likely to save us money over time. That doesn't mean they're necessarily always going to, but the one thing I've been clear about is that it isn't about trying to time the market. Trying to time the market is a fool's errand, and if you make that decision now, much like a lot of people made it in 2021 and 22 when they were trying to time the market by taking variable rate mortgages, well, you're going to find yourself in a lot of pain, especially if you end up in the types of mortgages that you don't understand and don't know the blind spots of, like fixed payments on a variable rate mortgage, which is, by the way, a mortgage that we have never done at Mortgage 360. Now, here's the thing. If the Bank of Canada doesn't do something, a mild recession, and we're pretty much in a recession at the moment, regardless of what the numbers say, regardless of what the data shows, we will look back at this time and probably find that we were in a recession. But if they don't do something to cut rates, we could find ourselves in a situation where we are in a more severe recession. But here's the problem. GDP in the US is continuing to grow. And if GDP in the US continues to grow and we cut interest rates, that could have the international money flocking to the US and leaving Canada, which could have a downward effect on the Canadian dollar, which could create a whole bunch of other problems. So Macklem not only has to deal with what's going on in Canada, he also has to deal with what's going on south of the border. And on top of all this, it is no secret that fiscal and monetary policy are rowing in opposite directions. So in other words, the work that the Bank of Canada is doing in order to reduce inflation is being hurt by everything that the federal government is doing, the Liberal government is doing right now with respect to spending. And the more money that the federal government is injecting into the economy through spending and through fiscal policy, so in other words, they're policies that are designed to make everyone's life a little bit easier, and let's call a spade by votes, are having the opposite effect of what the Bank of Canada interest rate increases are doing. So high and sticky inflation is very quickly moving from a central bank problem to one that is being created and fostered by the federal government. And I'm politically agnostic. I don't care if you're liberal, if you're conservative, if you're NDP. That is the reality of the situation right now. The more a government spends, the more inflation, and the harder the Bank of Canada's job is going to be. So the question then becomes, what do you do if you're one of those borrowers? Well, if you've got an adjustable rate mortgage and you've stuck with it, as interest rates come down, your payments are going to adjust, you're probably okay. You're probably dealing with the problem. You've got to deal with it over an extended period of time. And you're probably in a place where things are a little bit more expensive, but you're dealing with it. But if you've got a variable rate mortgage with fixed payments, or if you've got a fixed rate mortgage, you need to be planning right now for your renewal. Do not pass go, do not watch another video, do not do anything before you start planning how you are going to deal with the coming payment shock. And that means putting money aside. If you've got a variable rate mortgage with a fixed payment, you need to start looking at getting your amortization corrected, so increasing your payment. And then in addition to that, putting money aside as much as possible over the next few years. Now, some people think it makes sense to make extra payments. I'm not a big believer in that. I think you're far better to take the money, get it invested somewhere where it's safe, and have cash on hand in case you need it over the coming years. Because at renewal, if you have payment shock or if you need to make a lump sum payment, or if something else happens, having the cash in hand because you've been saving it and putting it aside is going to be the thing that prevents you from losing your home. And on top of all that, you need to get into the habit of spending less now. It is coming. If you have a mortgage coming up for renewal, you will have less money. Get in the habit of spending less now, because if you get to that point where you have a mortgage that's renewing and you have higher payments and you have not trained yourself to spend less, it's going to be even harder then when prices on everything else are inevitably going to be higher. So act now, understand the risks, and by the way, make sure you check out this video right here. It's really important about the fact that some banks may not renew your mortgage if you aren't a qualified buyer at the time of renewal.